Every single day, the entire global financial system is inextricably bound together by invisible, highly complex mathematical contracts. This chart shows the exact scale of these instruments. At the base, we see global gross domestic product. Rising above it are the global derivatives markets, $558.5 trillion in the over-the-counter market, and another $96.5 trillion traded on public exchanges. But that combined $650 trillion represents notional value, the value of the underlying assets these contracts track, not actual cash changing hands. If we look strictly at the gross market value, the actual money at risk, the volume shrinks to roughly $11.6 trillion. A derivative is exactly what its name implies, an instrument whose value derives from a secondary underlying variable, detached entirely from physical ownership of the asset itself. These instruments trade in two distinct arenas. Exchanges offer highly standardized contracts cleared through a central counterparty. Conversely, the over-the-counter, or OTC, market allows institutions to negotiate custom bilateral agreements. The global economy relies on these mathematical contracts to isolate and transfer risk. They weaponize leverage to either insulate commerce from uncertainty or threaten the entire financial system. To understand why derivatives exist, we must look at the foundational mechanism of exchange, the spot market, where assets are bought and sold for immediate delivery. For complex global commerce, the spot market has an inherent flaw. Future price uncertainty creates unacceptable operational risk over time. Imagine a U.S. business that owes a British supplier £10 million in 3 months. If the exchange rate fluctuates against them between the time the order is placed and when payment is due, that simple delay can wipe out their profit margin and force them into financial ruin. This introduces the first critical agent in the financial ecology, the hedger. A hedger willingly pays a premium to eliminate future uncertainty. Hedging does not guarantee a more profitable outcome than doing nothing. Instead, it transforms an unknown future risk into a fixed, mathematically certain present cost. The simplest tool for fixing that present cost is the forward contract. It is a locked legal obligation between two parties to transact at a specific future date and price. Because a forward contract is an equal exchange of future obligations, it costs zero capital to enter today. This diagram shows the payoff geometry of a long forward position. The x-axis represents the spot price of the asset at maturity, and the y-axis shows the financial payoff. We plot the delivery price on the x-axis, and the payoff follows a strict 45-degree linear path represented by the equation S sub t minus k. Applying this to our U.S. business, Import Co., we establish the fixed delivery price at $1.2225 per British pound for an August delivery. If the August spot rate rises to 1.300, the contract yields a positive payoff, saving the company money. If the rate falls to 1.200, the payoff is negative, meaning the company pays more than the current market price. While forward contracts carry bilateral counterparty risk, meaning one side might default, futures contracts solve this. Futures are standardized and cleared through an exchange to eliminate default risk entirely. Linear obligations perfectly neutralize downside risk, but they enforce a strict trade-off. The holder must forfeit all advantageous price movements in the underlying asset. To escape that rigid obligation, the market utilizes the option. This is a legal right, but strictly not an obligation, to transact. The mathematical cost of this asymmetry is capital. Escaping the linear downside of a forward requires an upfront premium. This chart shows how an option bends the payoff curve. We drop the y-intercept below 0 to represent the upfront premium paid. The line remains perfectly flat until it reaches the strike price, where it sharply kinks upward at a 45-degree angle. Consider an Apple December call option with a $340 strike price. At an ask price of $20.30 per share, multiplied by the standard 100-share contract size, the buyer pays a $2,030 premium, establishing a hard floor on potential losses. If the Apple spot price hits $400, we see geometric expansion. The profit extends infinitely above the break-even point, yielding a $3,970 net return. The inverse instrument is the put option. Hedgers use its inverted geometry as portfolio insurance to place a strict mathematical floor under their equity assets. Options mathematically reshape risk, They allow participants to purchase insurance against total ruin while maintaining exposure to infinite upside. Every risk transferred by a hedger requires a counterparty. This is the speculator, who willingly absorbs that risk in exchange for profit potential. Speculators are drawn to financial leverage. This leverage is driven by the mechanics of the margin account, which magnifies both gains and losses. This visual compares the capital efficiency of two identical positions. On the left, taking a £250,000 spot market position requires over $300,000 in upfront capital. On the right, taking the exact same notional exposure using 4 futures contracts requires a margin deposit of only $20,000. This contrast defines the absolute risk of ruin. In futures, losses scale infinitely against that small margin deposit. In options, 100% of the premium can be lost, but no more. Leverage acts as a structural multiplier. It allows speculators to control massive notional value with fractional capital, accelerating both wealth creation and absolute ruin. The third and final agent is the arbitrager, acting as the mathematical enforcer of the derivatives ecosystem. Arbitrage is the simultaneous transaction across 2 or more markets to lock in a completely riskless profit. Consider a cross-border pricing anomaly. A stock trades at $120 on the New York Stock Exchange, while simultaneously trading at £100 in London against a 1.23 exchange rate. High-frequency trading algorithms identify this discrepancy. They execute instantly, buying the London shares and selling the New York shares to net a risk-free $3 margin per share. The sheer volume of algorithmic arbitrageurs executing this trade forces the laws of supply and demand to violently snap the pricing anomaly closed almost instantly. Arbitrageurs are the essential glue of global finance. They aggressively eliminate pricing inefficiencies to ensure the mathematical models governing forwards, futures, and options function perfectly. The theoretical perfection of derivative geometry relies entirely on one practical assumption: counterparty solvency. When solvency fails, we encounter systemic risk, the catastrophic ripple effect within interconnected OTC derivative networks, where a single institutional default triggers a chain reaction of failures. In 2007, the high correlation of mortgage defaults shattered risk models, exposing massive vulnerabilities in the housing market. This culminated in the 2008 collapse of Lehman Brothers, demonstrating the ultimate systemic failure of extreme leverage and correlated risk. Lehman's fatal metric was a 31-to-1 leverage ratio. A mere 3 to 4% drop in the value of their underlying assets wiped out their capital entirely, trapping 8,000 counterparties in litigation. Systemic collapses contrast with localized rogue trader events, such as Jerome Kerviel at Societe Generale or Nick Leeson at Barings Bank. These rogue traders exploited their knowledge of complex arbitrage controls to execute massive, unauthorized directional speculation. The greatest danger in the derivatives market is never the math itself. It is human execution, when extreme leverage collides with a breakdown in institutional controls or correlation assumptions. The market ecology functions as a perfect triad: hedgers transferring risk, speculators levering it, and arbitrageurs pricing it. This combined chart illustrates the core reality of derivatives. They are strict tools of geometric risk manipulation, allowing precise exposures to be exiled from physical assets. Despite their complexity, they operate entirely on the basic mathematical principles of linear obligations and asymmetric rights. A derivative is neither inherently good nor evil. It is simply a flawless mathematical amplifier of human intent, capable of either perfectly insulating the global economy or accelerating its destruction.